So I think we have started, Jeanette.
Yep, you're live.
Great. So good afternoon, everybody, and welcome to some 300 people out there. I sincerely hope you're doing well and that this SCAMP webinar will be engaging and educational. Our topic today is navigating underwriting changes. How should developers adjust? I am Michelle Espinosa Coulter, Senior Housing Finance Consultant with the Housing Partnership, with the California Housing Partnership, excuse me. As many of you know, the partnership helps create and preserve affordable and sustainable homes for Californians with low incomes by providing expert financial and policy solutions to nonprofits and public partners. I have 4 fantastic panelists with me today. I want to thank them for generously sharing their time and expertise. We're going to spend about a minute with each of them, having them introduce themselves. We're going to go alphabetical by last name. So Parika, then Sonia, then Muja, and Aaron. So Parika, why don't you get us started?
Good afternoon, everyone. My name is Parika Bell. I'm with Union Bank. I head our Southern California office. I have a team there that even though we're in Southern California, we really follow all of our customers wherever they may go. But most of our originations are in Southern California, where we do debt, some equity, a little bit of everything around our debt products. And our customers are some of the best and brightest in the affordable housing developer business.
Sonia.
Great. Good afternoon, Sonia Ram. I am a director at City Community Capital. We are an affordable housing lender that spans the whole nation. Myself, I am based in Los Angeles, and most of my clients are California based, although similarly, I do have some clients in some neighboring states and do business kind of across the country. In terms of our product offerings, we offer both. We mainly focus on debt, and we offer construction and perm loans. Most often that is on our own books on the balance sheet, but we also do business every year with for Freddie and Fannie loans. So it kind of just depends on the transaction and what makes the most sense for your project. I love what I do. I've been in the industry. I've been at City Community Capital actually for 13 years. And yeah, I love it. It's a super rewarding career. I love the people side, and I do get deep in the numbers when we need to as well. So look forward to participating today. And thanks, Michelle, for inviting me.
Muja?
Hi, my name is Muja Risden. I am the Director of Housing at a Community of Friends. A Community of Friends is a nonprofit developer that has a mission to end homelessness for those with mental illness. And a Community of Friends has been providing supportive housing for about 32 years. All of our projects are supportive housing projects, all but 2 maybe. And we develop currently in 5 counties in Southern California. Most of our projects are in the city and county of LA, but we do have developments in Orange County, Ventura County, Riverside County, and San Bernardino County.
And Aaron.
All right, good afternoon, everyone. I'm Aaron Smith. I'm a relationship manager with CCRC, and I support our originations team in underwriting and closing new commitments, as well as funding our perm loans once the property has been built and has achieved stabilized operations. Just briefly about our organization, CCRC, we are a nonprofit organization based out of Glendale. And we've been around for 30 years now, and we provide permanent financing for light tech developments throughout California. And I will say that, of course, 2020 has been an unexpected year, to say the least. And just to offer an encouraging report, I just want to start off on a positive note with this panel that CCRC has had a great year. In fact, a record-breaking year in terms of new production volume. And our portfolio of loans that we service and manage has proven to be extremely resilient. And I'm sharing this encouraging report primarily to share our optimism and our commitment with everyone to affordable housing as we move out of this unexpected 2020 year and into 2021. So Muja, keep building, and Parika and Sonia and myself will keep financing. So thank you.
Great, Aaron. I want to thank you all again, panelists, for joining, and thank you to SCAMP for hosting this. We hope to take some questions at the end. And so if you have any questions, go ahead and place them in the chat. Let me start with the workshop thesis. The pandemic will continue for a while longer until a vaccine is widely adopted. Commercial real estate as an asset class has been negatively affected by COVID, while affordable multifamily appears to be performing much as always, i.e. extremely well, as Aaron just indicated. Banks and all their counterparts want to review all real estate transactions consistently. In that case, what underwriting trends should affordable housing developers be aware of during this pandemic? And we're going to break this down into a few different modules. The first module will really be things that are in our control. The second will be a discussion about counterparts. And then we'll talk about relationships towards the end of the conversation. During the within our control segment, I'd like to have Sonia and Parika get us started, and then Muja jump in and ruffle their feathers a little bit with some questions about what you've seen on your transactions and what others might expect.
Sure. I guess I'll start. So similar to Aaron, City Community Capital has seen our loans perform exceptionally well under the times. I think at the beginning of the pandemic, we saw a lot of kind of folks being very concerned about what collections were going to be like, and forbearance requests and whatnot. But most of those have disappeared, either expired or folks have withdrawn them because deals are going well. On the construction side, kind of looking at more of the underwriting, there have been a lot of different net things are business as usual. We've had an exceptional volume of business similar to CCRC. I think that is as a result likely of others in the industry exiting for a period of time. And so Citibank has done a larger share of the business. With that said, though, there have been a few trends that folks probably should be aware of. One is lengthened construction terms to really just help the client weather the delays that can occur during construction as a result of COVID monitoring. And those kind of also vary. Different regions have different restrictions, as you can imagine. We've seen some stuff in Orange County that there's a little stricter on how many folks can be in units at a time, how many folks can be on site, and if an inspection is going to happen. Certain cities make everybody vacate the unit, and there's just been a lot of protection measures in place that can delay. And then there's also just, obviously, depending how long things last, we've seen a little bit of some slowdown on the conversion side, not to the point where deals are converting later than with the additional extensions, but things are a little bit slower on that front as well. And frankly, that's just like the moving in also is an aspect, because you can't move as many people in at a time. And so so that is one aspect. Another in terms of the underwriting just is really commercial income. In the past, there's been a lot more, I feel like, flexibility around underwriting commercial income. Things are a little tighter these days. That said, I just closed a deal yesterday that we underwrote commercial income. They had a long-term tenant that was in a relation to the sponsor, was in partnership with the sponsor, and they were going to have an 18-year lease and is a strong tenant, and we underwrote 95% of the income. So there are exceptions to the rules, but that is one that in general, as you can imagine, commercial space is not in the same domain as affordable housing in terms of need. So those would just be to kind of start us off. Parika can add what she's seen as well.
You're muted.
What I would say is I know that the title of this is underwriting changes and underwriting what to expect. I almost want to reframe that to almost say, you know, what's the new context for the existing underwriting? More so because I don't, you know, when we look at all of our underwriting guidelines, none of that has specifically changed. It's not like, you know, we've rewritten our guidelines because we're in COVID-19 and because we are in a pandemic. But there is a little bit of a shift in context, and you know, a couple of things that I have seen and that, you know, might be surprises, or there's just more conversations. For instance, you know, my team and my group, I kind of call us the little department that could, you know, within our larger commercial real estate department. You know, for everyone out there, you know, you kind of think, oh, $25 million construction loan, that's big. But you know, in the grand scheme of things, you know, there's other departments, real estate departments of the bank that are doing much larger real estate deals, and so we're kind of off in our corner. You know, people kind of say they do weird stuff with tax credits. We don't really understand what they do, but they don't lose any money, so we'll just leave them alone. And they're fairly, you know, they do this good work for the bank. Well, when you have something like a global pandemic that kind of affects, as you said, all asset kind of classes within real estate, you know, we all kind of get brought into the forefront of, oh, well, what are you doing? Why do you want to deploy this capital? And we are deploying that capital, and we are closing deals. It just means that we are being asked more questions and asked to kind of fill in detail a lot more than we're normally accustomed to at the very beginning of projects. And so that often means that we're asking you for more detailed questions than we normally would even like to, right? We want to get going and get started as well. But it usually, at least at the front end, taking a little bit more, you know, give us more detail, so that we can help fill in some details for sometimes other people, frankly. Another thing that I mentioned, and I don't know if this is something, if I could actually put this in the locus of control, but I will say that, you know, one thing that is intrinsic to all real estate transactions, both affordable and non-affordable, are appraisals. And so what we've seen is that all of your appraisals that are coming in now, they're using comps that are a lot of times pre-COVID. And so what appraisers are doing, because they're professionals that are somewhat regulated, and they're also dealing with banks who are also very highly regulated, what do they have to do? They hedge, right? And so they're putting lots of cushion, from a little to a lot of cushion on their cap rates. And so the cap rates that we're seeing now for the first time in a while are really affecting some values and loan to value. So that's what I'd say for now.
Okay. Muja, what are you as a developer seeing that you feel like, okay, this is something that I can respond to. I don't like it, but I can respond to it. And
I know when we were having the conversation, kind of prepping for this session, you know, there was a little bit, we talked a little bit about, okay, you know, in the beginning, there was worry and fear that this, you know, this was going to happen, or this bad thing was going to happen. And now that we are, unfortunately, almost 9 months into it, we're seeing that, you know, thankfully, people's worst fears have not happened. And so I think it's a little bit sort of two parts. You know, now that people have seen that their worst fears haven't been realized, and that the, you know, this department or these loans that they maybe weren't paying as much attention to before, that they have been paying a lot of attention to, like, is it easing? Are they continue, you know, are you still getting that same level of scrutiny that's being passed down to developers to answer? And also, you know, like, we closed a deal pre-pandemic, and then we're in the middle of, or the kind of the early stages of a closing now, so we're not in the thick of it, but are you, are the banks, or are you adjusting what you require of people, the level of detail, or the level of questions based on your relationship or the strength of the project? Or is it like everybody has to answer a bunch more questions and provide much more detail just because you have to do it?
Yeah, I think that's a great question, and I think that's sort of directed at me since we're currently in the middle of a deal together. So she wants to know, am I gonna? Is Citibank going to be asking a community of friends lots of questions on this closing? And I will say, similar to Parika, I would say that there's a lot of extra vetting on the front end of a deal these days, particularly for a new to bank client. Not as much for an existing client, but there still is a little bit extra vetting. Once the deal is actually a go, once you've signed an application, we've taken it to initial credit committee, you sign an application, and we're kind of off to the tracks to closing, it's very similar. So I wouldn't say there's dramatic differences, or really you can't think of too much I can't think of real significant differences once you're at that point. I would say it's very much on the front end, kind of like Pricker was saying. For us, it's, questions, and it also depends on who the client is, the relationship you have, how many deals you've done together, have you delivered on those deals well, which obviously with the community of friends and city, we've had a great relationship, and deals have occurred as expected. And we do have a very collaborative relationship where we communicate when there's issues, and so things get addressed up front. So community of friends would be one of those. I mean, the relationship aspect has an advantages in these times, and so you would definitely get that benefit at the bank. So I don't think things are that dissimilar. Some things to think about, though, if for folks that do have deals that, let's say, are more complicated in scope than they're used to, or they're a newer developer, or if there's some reason, or it's a super large deal, there are going to be a few more questions on that front end. And so just kind of to elaborate on that, I would say for us, that would be kind of on LIHTC, who is your upper tier investor? I probably would, folks will want to know that if it's a really large deal that not too many investors could finance, or it's a really complicated deal with a huge stack, or if it's a kind of deal that you haven't done before. So there are some of that. I'm trying to think what else on the front end would be kind of vetted that might be atypical. I mean, I mentioned the commercial income piece, that's one. And I agree with Parika on the appraisals, that's something to consider. There would be, I guess, the partners too, I would mention. So like, who's your GC? Have you worked with them before? I'm seeing a lot more modular deals. Those are going to be really vetted on the front end as well. Those are just some of the ideas of things on the front end. But I think once you get going, the deal is pretty status quo. But on the front end, the relationship plays a huge role. And being a new client, there will be a fair number of questions. Like Parika said, that list is a little longer than normal to just get going.
Well, Parika, do you want to jump in here with best practices?
Well, Muja, who hurt you? Who hurt you? Who did it? Who did it? Sonia
I
said
think
her, so who did it?
I think for us, we're trying to, right, like develop, like as a developer, we try to anticipate as much as possible, and right, that's how we mitigate our risk. And especially when things, in the midst of things changing, especially if we're getting a bunch of questions, if we were to, that we haven't been asked before, or it's not, we're not used to being asked those questions, and they feel like they're coming out of left field, then, it leaves us wondering, like, what is going on? Is it, right? Like, is it us? Is it the deal? Is it the market? Or like, why are you doing this to us? So,
well, it seems like there's almost two things, Muja. Like on one, it seems like you're getting questions that for you have no context, and that can be very hard, because I mean, if that's not being communicated, because even if you have an answer, if you don't know the context, you might get 3 more questions, right? Because you're not hitting the appropriate context that, you know, that the other side is asking you. And what I would say in general that, you know, we like it when our clients are anticipating, because it means that they're thinking about their risks, right? We don't know all of your risks. We do our best to ask those questions to get into what we think are the things that we need to mitigate risk. But of course, you have other things, and you have a bigger view of the deal. And so for a developer like you, I'm probably not asking a million questions because you've already asked them and you've already answered them. What we do like to see, and this is just touching on something that Michelle mentioned, because she, or actually I think it was you, Muja, when you're like, well, you know, everything that people said would happen didn't happen. And I would mostly agree with that, but I would also say that, you know, we're still in it, right? And we still have deals in construction, and we don't know how they're going to come out on the other side. They all look pretty good, mostly. And a lot of the questions that we're asking are just to make sure that you're thinking about them, really. We don't expect you to have the answer, but if we ask something like, okay, like, what are your lease up contingency plans? Like, it could be, you know, your project is already built, so we're not worried about you not finishing, but okay, are you going to be able to lease up in this environment? You might not have the exact answer, but just knowing that you're thinking about it, you know, makes us feel better, I suppose. And so that's most of, if I would say we have additional questions, it's really about those outliers that no one really knows the answer to.
This might be a good time to segue into the role of counterparties, because you all, you know, we all have relationships with each other, and so we know, you know, what we just know each other. But there are a lot of counterparties out there that don't have the same kind of relationships that we do, whose reports we're relying upon. So maybe, again, going sort of round robin, we can talk about the role of those consultants and maybe some surprises that developers, you can warn them of, and things that they can look out for. Sonia, would you like to start?
Yeah, I would say we've already touched sort of on the appraisal, and that would be the biggest one that I would say as well. Parika kind of alluded to the cap rate concerns. It's really for us, and I don't know if this is the same at other banks, but for us, there was a clampdown where appraisals have to address COVID in their analysis. And so it has to explicitly say that they factor that into the analysis. And that was a few months after the pandemic that occurred. And so as a result, yeah, you see different appraisers adjusting values in different ways. And the most common is, you know, an increase in the cap rate. And in a lot of strong markets, that's not influencing anything because deals are mainly DCR constrained. But on some of these outskirt markets, I am definitely looking at that on the front end. And so when clients come in with X perm loan, I'm going to CoStar and looking at what those cap rates are in that market. And I can't have a crystal ball on where it's going to come out, but I have a good guess, and I'll come to them and say, hey, you have this modeled. If I were to guess, I'd guess it's coming in around here, and this may take a hit to your proceeds. So really kind of working on the front end on that front. On the construction, I haven't seen too much. Folks have really adjusted, and I guess folks are going out to bid wells with their subs. So on the construction review, I haven't seen too many changes on that front. Our consultants have seemed to think that bids that are coming, you know, costs are appropriate. And then the only one for us is environmental. So really for me, it's mainly that appraisal, the appraisal risk on a deal.
Yeah, and I'll speak a little bit to more financial counterparties. You know, again, the questions aren't different from pre-pandemic. They just maybe have a more significant weight. And again, going back to what Muja was kind of saying about how ACOF, you know, tries to anticipate risks and questions. These are all questions. The same questions and things that we have really are things that you should also have, right? Because it's your deal, and these are your partners as well. So, you know, in terms of investors, if we're on the other side, and we're the lender only. We are looking at the syndicators. How did they perform in the last downturn, right? Because right about 2007 and 2009, we were all holding hands and saying, are we going to make this deal work? We're going to make this deal work. We're not there this time, but what happened back then does inform maybe a little bit of how we feel now. So we're looking at those. We're looking at the end investors as well. Like, okay, how committed are the end investors to the mission of affordable housing, doing deals? What I think is great is that we're seeing a lot of new investors come into the market. It's great. We're seeing healthcare agencies. We're seeing different companies that we haven't seen in a long time. And so, it's a great thing. We also just want to make sure that they're in it, and or they're going to be at least in it for the time that we're in the deal. But really, we hope that they're in it for our customers as well. And then, of course, looking at our city, county, and state partners, as far as we can tell, they're all really reliable. It's just more in terms of, okay, well, given that this is a stress for everyone, how long will it take to close? And does that impact projections in any way? And then, of course, if we're not the permanent lender, we're, of course, looking at our permanent lender partner takeout. So I'm looking at Aaron and going, hey, you're going to do this? You're going to come on, you're going to do it? But for the most part, we are doing our own perms, but in other cases, we're relying on partners like CCRC, or maybe we might have a Fannie Freddie takeout. So really those questions, again, aren't really much different than pre-pandemic, but I would say that they do have a little bit of extra weight to them.
Okay. Muja, have you had any LTV issues or any cap rate issues come up on your specific transactions?
We haven't had that come up on our transactions, and I'm not sure. What we did have is a rent issue come up in a market study. And I'm not sure if we would have, it's unclear to me if we would have had the same issue had it been pre-pandemic, or this is affected by the pandemic, and what may or may not be happening with rents in some communities. But I think that's all that's come up so far. We tend, because all of our projects are supportive housing projects, we try to minimize our perm loan, but more and more supportive housing, even supportive housing projects have perm loans. But that might also help. That approach might also help on the LTV issue, at least on the perm loans. But yeah, we haven't hit it yet. Hoping not to.
And I'll echo a lot of what Parika and Sonia have already said regarding the appraisal. There's really two big categories of underwriting here. We have, the debt coverage cash flow requirement, and then the LTVs that require LTV requirements that Sonia and Parika have alluded to. So we're in a lower interest rate environment for sure. And we've seen an unprecedented dip in the 10-year treasury from, I think, 180 bips earlier this year to as low as 50, 60 bips. And generally speaking, given the lower interest rate environment, which supports more debt in terms of cash flow and debt coverage requirements, we are seeing, I can think of at least one specific example right now where LTVs could be a limiting factor in sizing the perm loan. So appraisals are to be considered perhaps even more so now with value conclusions, and of course cap rate assumptions matter. And as Parika was saying before, appraisers may be adding 25 basis points, 50 basis points or more on the cap rate, given the COVID environment and sort of covering all bases and the uncertainty around what's going on. So definitely something that we've seen more of this year in terms of LTVs and the relationship with the lower interest rate environment.
Okay. Actually, I was about to transition over to you, Aaron anyway for the perm lender perspective. So why don't you take it away?
Sure. So yeah, I'll talk a little bit about what we're seeing in terms of asset performance and underwriting shifts. I have a number of points. I'll keep them brief, but I believe these are helpful points to consider as we look back on 2020 and move into 2021. My first point is actually what I just mentioned about the lower interest rate environment and really sort of digging into the appraisal and seeing what the assumptions are in terms of cap rate, market rate, rent assumptions, et cetera. Because LTVs could be a constraining factor in perm loan sizing. So I already kind of touched on that a little bit. We've already sort of talked about the appraisal a little bit. So second, and Sonia had alluded to this before already, is these longer construction loan terms and longer perm loan forward commitments. We've seen an increase in the requested upfront commitment period for our forward rate lock. Construction lenders may be requiring additional cushion for the construction period, maybe based on their costing review due to the uncertainties created by COVID. And construction lenders typically want to see our forward commitment cover the length of their construction loan term so that they know that us as a takeout source will be there. And third, we've seen a reduction in market rents, especially in San Francisco. And this could lead to market rents being lower than Section 8 or other rental subsidy contract rents. And I would note that as a forward looking, I would note that lower market rents today could lead to lower FMRs or fair market rents for Section 8 contracts, and perhaps 2 or 3 years out from today, since there's sort of a time lag in calculating and reporting FMRs that really help determine what the level of rents are in the Section 8 contract. So our long-term cash flow underwriting may reflect the potential for perhaps little to no growth in FMRs. And actually, on a similar note, we could also see AMI growth being flat or declining in the coming years due to lower AMIs this year, since there is also the similar time lag in reported area median income or AMIs. Fourth is at CCRC, and I alluded to our sort of servicing portfolio before at the beginning of this call, but at CCRC, we do have the added insight that comes with servicing and managing this year over 300 loans and bonds, totaling about 800 million. So we do have some insight into the performance of properties. And in our servicing portfolio, we are seeing that properties with Section 8 project-based vouchers are performing well. And this is, of course, in part driven by the fact that the Section 8 contract makes up for the loss in rent in whatever the tenant may be unable to pay due to job or income loss circumstances. And fifth, Muja, you had asked this before in terms of the maybe additional due diligence or what financing partners want to be looking for. But generally, since we are providing forward commitments, we're underwriting the perm loan at construction close, but we're not funding until conversion after the project is completed. So at conversion, we are generally requiring some additional due diligence in terms of like specifically delinquency reports and pass-through reports, given the impact that COVID is having on jobs and household income, of course. So this additional due diligence just allows us to dig a little bit more into more of the economic vacancy of a property, if any, even if the property might be 100% physically occupied. One last point that I would make is I would like to highlight this point is the importance of having an experienced property management firm. There is an added degree of flexibility and success with vertically integrated organizations that have both development and property management arms. There's an extra layer of comfort and control with developers managing their own properties. And one additional point on property management firms is with a lot of, I talked about Section 8 contracts. And so with a lot of properties benefiting from project-based vouchers and other rental subsidies, I think it's important that the property management firms, whether they're in-house or third party, that they understand the importance of requesting rental subsidy contract rent increases from the respective housing authorities, if available, since HAP contracts typically include language that the owner of the property is responsible for requesting these contract rent increases, typically annually. I think it's crucial that this communication and expectation really is solidified between the developer and the property management firm in order to ensure that the property is capturing all of its potential income. And so I think that helps everybody, right? The equity investor, the perm lender, the developer. And so I just wanted to highlight that point. And those are really my points that I wanted to share. And hopefully they provide some clarity on our underwriting perspective, at least from a perm lender standpoint.
Parika or Sonia, would you like to add to that?
No, I think that Aaron was pretty comprehensive in terms of, looking at, what happens after construction and portfolio. I agree with him specifically on some of the rent trends we might be looking at. And that's definitely something that we're also looking at as well. Again, asking questions because we don't know what's going to happen. And we know that our customers don't really know either. And I know, Michelle, that you had asked about, I think you asked Muja about whether she's seeing LTVs and rent stresses. We've typically not seen those, at least on my side, really on the supportive housing side. We've seen those more where people may be doing income averaging deals, or people are doing deals that are more heavily skewed towards 50 and 60% AMIs. And so, again, not looking to over underwrite or be too conservative, but really kind of looking at, okay, well, what could happen to rent growth given what we know now, especially in certain markets.
Mm-hmm. Sonia?
Yeah, I don't have too much to add. I would agree with everything that they're saying. And I would say that the LTV issues also, in addition to the asset type that a Community of Friends focuses on, I would say it's also a bit of location. So it's generally kind of more outskirt markets that you're seeing LTV constraints. And from what I've seen, a Community of Friends generally works in, major markets. So.
Which brings me to the relationship part of the conversation. And I got a really interesting question talking about market rate developers that are moving into the affordable arena. And let's talk broadly about relationships, but also, there are some interesting new players that are coming in, and, do they get treated differently or the same as a Community of Friends and some of the other more established affordable housing developers?
Started
So,
if you want, Michelle.
Yeah.
Because I closed a couple deals this year with a new developer that was a market rate developer that's moved into the affordable space. So I feel like I have a pretty good baseline for the question. So I would say, a market rate developer has a lot of advantages over someone who's never developed housing, obviously. But I do feel affordable housing is a niche market. And so they typically have the advantage of having a strong balance sheet. And so that really does serve well in terms of, capital and feeling comfortable that there are dollar signs behind the institution. But they're also still, the affordable housing experience is critical. Folks want to know that it's going to be built as required by all the subordinate lenders. Folks also want to know that it's going to be managed on the back end well. And so I think if you're a market rate developer entering this space, it's key to be partnering with partners who have relevant experience. And so if it's because I've talked to a variety of different market rate developers that are moving into space. So if it's, you're a hotel developer that is moving into permanent supportive because it's a similar asset type, then you need to be partnering with, the community of friends or other sort of developers who have that niche market. And similarly with the property management, there's also a lot about the relationships. So working with a GC that you've worked with is great, but working with a GC that has affordable experience or has someone on their team that's built affordable is critical, is even better. So I think that there are advantages. It's not like they're coming in blind, but there are definitely partnership aspects to it that will help strengthen your case in coming into this space right now. And I don't know, did you want me to go into the relationship side as a general basis, or should we stick with the market rate?
Let's talk about generally relationships in general. Yeah.
Okay. Yeah. And I would say more than ever, relationships are a critical aspect of building right now. Citibank is kind of known as a relationship bank. So a lot of the vast majority of the business we do is, repeat clients that come to us for the execution. And I would say that in normal times that plays dividends. So if you have a relationship, there are exceptions that you'll get, there are waivers because folks know that you're going to deliver. Now more than ever, it is a huge advantage. So for us, we've, similar to others on the panel, we've had an exceptionally busy year. We are generally very high volume shop. I think affordable housing finance, always the last 10 years, we've been the #1 bank. So we're very busy generally, but this has been an exceptionally busy year. And so as a result of that, there's twofold. There's one that all the folks at the bank are busy. And so folks are like, wait, why are we doing this one-off deal? So there's been a lot of elements of like talking about, if you're bringing particularly a new to bank client, it's what's the relationship potential there? So it's weird questions that I have to ask folks on the front end is like, what other business do you have that you might, not that you're necessarily going to work with us, but that you'd consider working with us down the line, because there's just such a strain in capacity. And then there's also obviously the execution aspect in the time period that we're in, knowing that if I have a client that I've done, several deals with, and they've always delivered on time, folks feel very comfortable doing the next project with them in these uncertain times. And so for us at the bank, for new relationships, there is a added layer of vetting that is occurring now that in the past wasn't occurring. And so there are discussions. Again, the nice thing is once you're in and the process goes through once we're going towards closing, but definitely new relationships. Be prepared for a few extra questions on the front end. Not that we don't all like bringing more folks doing this amazing work into the industry, but we just got to make sure that all the ducks are lined. And frankly, I'm sure the others feel similarly. We want to set these projects up for success. So we want to make sure that they're structured properly. And again, I've had a couple new affordable housing developers that I've financed this year. So it's not like it's not happening. It's just there's just a little bit more work to be done on the front end.
Rika, what are you seeing in partnerships? What are you liking out of your partners?
I mute myself so I don't interrupt people, and then we're not a production shop. We are not a production shop. The people on my team, they're relationship managers, they're closing deals, they're kind of looking at the deals post-close. And so, we have to focus on depth, and in order to, kind of keep the production that we have, like we obviously want to see it built and we want to be paid back. But we also have to kind of pay attention to our customers as like a whole entity and make sure, that they continue to be strong so that they can do the next deal with us and the next deal, and the next deal. And so, that type of, for kind of our value proposition and the type of business that we do, which is a little bit, kind of deep in that nature, it takes a large, sure investment in customers and in time and getting to know them. And so, we very much shy away from doing one-off type of transactions or transactions where there's not a whole lot of continued relationship potential. And so, you know, we value relationships. I think everyone says that and will say that. I think during this stress time, I think, and you know, it really doesn't have much to do with us as an institution, it's more of our customers. I would say that if I were one of my customers, I wouldn't want to be terribly transactional right now especially if they're closing deals. You know, but I do think too that there's also room for innovation as well. So, you know, relationships are important more now than ever. And it goes both ways. I think that, you know, just as I tend not to think it's a great idea for developers to be terribly transactional, we can't be terribly transactional either. If there's something that you need, there's something that you need someone to bend and push on, and that's your partner, that's something that you should be asking of your lenders too. So I think it goes both ways.
Muja, is well, first of all, so yesterday in our preparation, Aaron brought up a really good question about, you know, what are you looking for from a financial partner? Are you looking for, you know, the one-stop shop, or are you looking for the best pricing? So maybe you can talk about your lender financial relationships for your deals, transactional, relationship, everything in between.
It depends, but you know, I think I mentioned, you know, this question of is it whoever's giving you the best price or the best the most money? And you know, I think that rises to the top of the list, I think only for projects that for it to pencil. By the time we're getting, you know, we're moving towards closing, you've got all your funding committed, you've got your costs, and to make this thing pencil, you have to go with the whoever's giving you the best pricing. I think that's probably, in my mind, the only time we're making a decision like that's at the top, right? It's you need it, but you know, most of the time that's not. It's a mix of factors. And I think right now, during this time of uncertainty, you know, we're looking a lot at, okay, who do we think is going to hold hands with us and, you know, be there as a true partner in this deal if things go south, if something happens, if the economy worsens, if somewhere along the way the value, you know, drops and the deal's upside down, or you know, we're really delayed, like who's going to be the most understanding and think about the project and our relationship and not just their own financial interest, which, you know, that combined with, okay, what is it that they're asking of us in terms of terms up front? Because it feels a little like, I feel like it tells us a little bit. Are they asking for terms that we haven't even started, right? The deal, they're trying to win our business and they're already asking for terms that tie our hands and, you know, are asking ACOF.
You want to give specifics?
Oh, sure. Like, you know, some of the things we've seen recently are like liquidity covenants. Some of them have been, you know, what is it? Subsidy loss reserves, like huge sizings of those, or, you know, are different types of guarantees or longer, or wanting us to show them, you know, I guess harder questions or somehow prove like everything's going to be okay. If
Muja,
yeah.
That's when you have to ask them who hurt them.
You know, but it's like, I can't tell you what's going to happen. Like you said, Parika, right? Like we can think and try and plan and mitigate best we can, but I can't tell you with certainty what's going to happen. And so, and sometimes it is their line of questioning. Like, do we feel like whoever's on the other end understands what it's like to build projects like this, and to go through this process? Because if it feels like they're not, especially in a time of uncertainty, that's not who we want to sign up for, to be in a relationship, right? For 15 years or longer.
So I'm gonna move quickly to Aaron. You want to talk about the importance of relationships with CCRC?
Yeah, sure. Those are all good points, Muja, that you make. And we're all sort of treading through murky, waters this year. There's a lot of unknowns, and we're all sort of handling this situation together and trying to figure it out together. And as I mentioned before, there is the upfront underwriting construction close with our forward commitment. But there are new sort of issues that come up during conversion when sort of we get the benefit of looking at the actual operations of the property, and we're seeing what impact COVID has specifically on tenants and their situation and their ability to pay. And of course that ties into the whole achieving certain metrics in order for us to fund our perm loan. And so there are various challenges that arise during conversion with income on the income side, perhaps a lot of delays where the developer might be needing extensions on the construction loan side and therefore the perm loan forward commitment side. But I think a lot of these challenges, they're really opportunities for us as the perm lender and the developer and even the construction lender and equity investor. There's so many people at the party, but there are opportunities for everyone to kind of get together and really figure out and really go off of that relationship and determine what the best strategy is moving forward, because it's really a win-win situation. It's ultimately a win for the tenants that are living at these affordable housing properties, but it's a win for those who have a vested financial interest in the property also, and a mission-driven purpose for the property that Muja mentioned before, right? And so when one party wins, everybody wins. And so these opportunities to sort of not see these deals as transactional and sort of step back from the risk, but rather embrace it and see where we can sort of meet and really vet through the, get into the weeds and figure out, what extensions are necessary, what the adequate perm loan sizing is, what's our, how has the developer stepped up historically. Their portfolio might be a fantastic portfolio, so there's confidence in the way they manage their properties, and this stuff is sort of out of their control. And so a lot of challenges, but I think a lot of opportunities to build that relationship. Mm-hmm.
I want to get to some interesting questions that are coming through. Aaron, you had brought up the FMR, the sort of crystal balling about FMRs, and so the question has to do with if FMR rates decrease, is it possible that Housing Authority could decrease the current PBV and HCV rents? It is in the language of the HAP contract, but not sure that was something that happened during the last recession. Did you all see that during the last recession? I'm going to do sort of a round robin on all of that. So did you see the gist being, did you see the overall payment standards coming down during the last recession?
We actually did a study on this, like a really quick study on this a while ago, where we were looking at how fair market rent moved between 2008 and now. Mm-hmm. And I'm not going to be able to quote it exactly, but But about 2008 to 2010, though, at least the fair market rents, and I'm just talking about LA County and Orange County, don't know about others. Those rents continue to go up 2008, 2010, and then I believe from about 2011, maybe 2013, maybe even 2014, there was a slight dip, or it remained flat year over year. So that's what I know about the FMR itself in terms of like how it trended. You know, I don't know how that translated with respect to the actual contracts. Have not done a study with respect to that, unfortunately.
But this isn't something that the banks are building in, is this expectation that the FMRs are going to decline?
No.
No, not that the FMRs on subsidy contracts themselves. I do know that there's conversations just in general about, okay, well, should we be really trending rent at 3 or excuse me, income at 3.5? Should we, you know, do stress testing, right? Assuming that it's flat. And I think that that's more of the word. It's not so much, you know, oh, okay, I'm going to cut your perm loan because I'm assuming these rents are flat. It's more of, I'm going to do this background stress testing, which frankly, I think our customers should be doing all sorts of stress testing as well, just to take a look at, you know, what would happen or how much cushion you actually have.
Along the same lines, are you subsidy loss reserves? Are you approaching subsidy loss reserves any differently than you were?
We never required Section 8 reserves. I do know that certain investors have before and do. We on the lending nor on the investor side have really ever required a specific Section 8 reserve. I know that a lot of agencies now are also looking at transition reserves for certain programs. Really, we take a look at that operating reserve and we look at it and we say, okay, you know, a lot of people kind of start out with the TCAC minimum. You know, do we agree that that's a sustainable operating reserve? We look at it deal by deal. Sometimes we have increased it or asked them to increase it, but not at the level of, you know, really looking at a separate Section 8 reserve.
Yeah, and we don't have a Section 8 or an operating reserve on our projects, and we don't have operating reserve requirements on the debt side. So it's really what equity requires that the project will have, but not so no change as a result of COVID.
Yeah, and similar to us, there's no specific subsidy loss reserve or transition reserve, however it's structured or called on our end. But yeah, operating reserve is key, and we're seeing longer 6-month operating reserves on some properties, and but that's the primary focus there.
And Mija's gonna check us. I've been looking at her to see if she's going like this or like this at any of what we're saying. I'm telling the truth. I'm telling the truth.
It's recorded. No.
Well, actually, we have to stop it there. So sorry. We'll beat you up about reserves on another call, or we won't beat you up, but other people about reserves on another webinar. So I believe we have hit the 4:30 mark, and I want to thank again the panelists and everybody that joined in for today. I know we have a number of questions that we didn't get to. My sincere apologies, but I'm sure that any of the people on the panel would be happy to field your questions. I'm looking at all of you, and in the meantime, we just look forward to connecting informally and in other ways over Zoom and webinars over the holidays. And be safe, everybody, and we'll see you soon. Thank you. Jeanette?